What's up, fellow traders? Hope everybody's having a good weekend. I'm just going to go over today some notes and how I'm going to play this market going forward. So it's broken into 4 parts, right? So the first part is going to be evidence that the market is less concerned now about inflation and more concerned about recessionary risks. So I'm going to go over some market evidence that the inflation trade is dying down. I'll go over additional evidence as the second part that recessionary concerns are now taking center stage. The third part is going to be the effect on corporate earnings, and I think that's going to have an impact on equity prices. And then lastly, where I think the market goes and how I'm going to be playing, how I'm going to be trading this over the next couple of days and weeks. So let's talk about how the recessionary trade may be dying. So here, oil, in addition to many other data points that have accumulated over the past few weeks, seem to tell us that the inflation trade is over. So here's one little clue to kind of coincide with that statement, the price of commodities. So here's the month-to-date chart for all the commodities. And you can see here metals and food and energy, just all are having a really, really bad month. And that leads me to believe that the inflationary concerns that were kind of built into the market are subsiding somewhat. Okay, so 5-year tips have led CPI year over year by 3 months. So we can see here that the tips are really rolling over, which would lead me to believe that we should see further declines in the CPI. I've always made the case that come September, October, that Jerome Powell may be able to take a victory lap, because I do think there's going to be a decline in the headline CPI number, in the core CPI number, and more importantly, what they tend to look at, the PCE. So I do think inflation has peaked and is coming down. So here, 5-year break-evens unchanged on the day, even when nominal rates moving 6 basis points higher. So this is confirming his theory that the market is focused more on growth rather than inflation. Oil, copper, and other commodities have come under heavy selling pressure today. That's a good thing because it's mounting evidence that inflation may be peaking. I agree. Meltdown in wholesale gas prices, which is the white line here, means serious relief at the pump over the next couple of weeks. So you can see here's the yellow line, and this is prices at the pump. So we could see prices start to come on in, which would be a great relief. But also evidence that the inflationary trade may be over. So not only will U.S. consumers see relief at the gas pump, but the household utility bills may moderate too. So here's natural gas prices. They've really come down hard, and this tends to show up in the energy services CPI. So I would expect to see some relief in the utility bills going forward. U.S. gasoline consumption remains substantially below the 2015-2019 era average. This kind of makes sense. A lot of folks, I mean, I think there was a funny, right here. So here's consensus among oil, right? So Citi came out and they're warning that oil can collapse to $65 a barrel, whereas JP Morgan can see $380 a barrel. Huge discrepancy there. I'm leaning towards it coming down only because the cure to high prices is high prices, right? People will start to pull back on their driving. People will travel less. If we are heading to a recession, there's going to be less goods traveling on the roads. And on top of that, coming out of this pandemic, I think a lot of folks have become accustomed to working at home, being productive at home, as opposed to having to commute to the office every day. So because we have that, let's call it that experience from being productive at home, it gives us an option to drive less. So I don't think that we're going to see oil spike up here to 380. I do think that we're going to see further declines in oil. So the market right now, and I'm talking about the oil futures market, is in huge backwardation. And we're talking going way out. So this is actually the near month versus the 11th month out contract, which is in the red. So anything above zero here is backwardation. It normally should be in contango. So to spot prices is going to be lower than what the forward prices are looking at. And especially at going out 11 months, there should be some type of normalization in there. But no, we're seeing backwardation going out 11 months is still at very extreme levels. So let's take a look at this real quick. So the last time we saw this type, or going back to 2008, right? It was in backwardation. And what we saw here is at the price of energy or oil, this is Brent, fell from about 150 all the way down to about $40, right? So this was a major sell-off as that backwardation took hold. Here we have, looks like in 14-15 range. 2014, 2015 was in some pretty good backwardation. So here's 14-15, and we see here Brent fell from, call it maybe 110, and this one dropped all the way down to like $30 a barrel. So again, preceding a big sell-off in oil. We saw backwardation coming in here. This is the 2018 and 2020 regions. So 2018 to 2020, we had the ultimate decline from $80 a barrel. This one went all the way down to 15. This pandemic area might be a little bit skewed, but for the most part, oil did come in. So now, here we are in major backwardation, going out 11 months, and I'm anticipating that we could see a decline in oil. So I'm going to go ahead and I'm going to agree with the analyst over here at Citi, saying that oil may collapse to $65 a barrel by the end of the year on a recession. So I'm going with that story. All right, so you can make the case that, okay, we have the Russian-Ukraine war that's going on, and that's abnormally affecting the price of oil. And yeah, there are going to be sanctions that are coming into Russia that's going to limit them from selling their product, and or as a means of punishment or as a means of weaponizing the oil. Putin is going to take, or specifically take, energy off the market, gas and oil. I don't buy into that for two reasons. Number one, Putin is not going to leave that type of vacuum in the market, right? So if he has an ability to sell, he will sell. And trust me, there is going to be a buyer. So as in terms of Russian oil and gas coming off market, yeah, I mean, some of it will come off market, but there will be a buyer, there will be a seller, and I don't think that this is going to warrant oil running up to $300 a barrel. So just calling bullshit on that notion. If there's a willing buyer and a willing seller, that oil and gas will make it to market. Just my opinion. I could be wrong. This guy is showing the short-term cyclical nature of oil and anticipating that oil can continue to fall further. You can see this on my chart too. I have these here bars represent cyclical times for oil, and see here we're coming up and should start rolling over soon. So I also agree with this, and that shorter-term cycles are indicating lower oil prices. So here it is. So it begins. The work the Fed is doing by raising rates is starting to take a bite into the housing market. So you can see here, home sellers are slashing prices all over the country. Some homes are down more than 30% here. You see that? 20%. So yeah, home prices are coming down. This is in Phoenix. Phoenix now has more homes for sale in 2022 than it did at the pandemic start. 125% increase in inventory surge in 2 months. So buyers are gone, sellers are desperate. They're saying this is what a housing crash looks like. It could be. But for the most part, I think we're seeing the higher rates take a bite into the housing sector. Copper, right? Copper has a PhD in economics. Copper has long been considered a valuable economic bellwether because of its multiple end uses in several industries. It's down 22% in a single month. That's a big drop. And that's trading at the same level as December 2020. Another clear sign the global economy is slowing down. Pretty fast, actually. Copper price down 33% from its all-time high in March. Just more evidence of that. So this is the weekly chart of gold, and we can see here that it ran up in anticipation of all this inflationary concern, but now has started to break down. So if inflationary concerns truly are in the backseat and we're worried more about growth concerns, I would expect to see a continued sell-off within the gold space. How about food, right? So corn, wheat, and soybeans are all down 25% from their highs and below the levels they were before Russia invaded Ukraine. So we're seeing also inflationary concerns start to dissipate when it comes to food. That's always a good thing. Right here, wheat has erased all of its gains for the year. Also looks like corn and soy are rolling over. Fertilizer prices are peaking and trending lower. Used car prices are also down. Here's another one, used cars. Used car prices are down 7% over the past 6 months. So this is one of the first areas to spike higher in advance of broader inflationary measures. Hopefully the current downturn is a leading indicator of lower inflation to come. I agree. All right, so we're transitioning from inflationary concerns to recessionary concerns. Here we see the leading sectors in the market have been healthcare, staples, real estate. These are all economically defensive sectors. You would expect these sectors to outperform if we're heading into an economic slowdown. So we are seeing that in terms of sector rotation right now. I went over the inverted yield curve. So here are the twos and the tens. You can see that we inverted again. So this is usually an indication that there is a recession coming somewhere in the horizon. We're also seeing credit spreads start to deteriorate. So this person here is looking at the relationship between the Fidelity Capital Income Fund and the Vanguard Treasury Fund, one being risk on, one being risk off, and you can see here that they're starting to break long-term trends. So people are migrating out of the risk on trade, going into the risk off trade in anticipation of a coming recession. And this chart here shows that same ratio, so it's the Fidelity Capital Income, growth in income, and the Vanguard Treasury, and he's showing here that when the line is declining, which is here to here, here to here, here to here, you can see that the S&P 500 tends to have a difficult time. And when this line is going up, the market tends to go up. So right now, again, showing more headwind, that there's money coming out of the risk on trade, going into the risk off trade, which would be a bad sign for further equity gains. So more recessionary fear, right? So this person had tweeted out job openings declined the most since the 2020 recession. Most companies are overstaffed after the unsustainable growth financed by the government last year. So here you go. Job openings starting to come down. I think the higher rates are starting to take a bite in the economy, and we're seeing more evidence that we could be heading for a recession. Will the ISM manufacturing PMI soon fall into contraction territory? So yeah, we can see here is the Goldman Sachs cyclical defense ratio. It has really come down hard, and you can see it tends to lead this ISM manufacturing PMI, which is currently at 53. Anything below this 50% level would mean contraction and would mean a recession, at least in the manufacturing sector of the economy. More with the PMI, ISM stuff. Last 5 times the spread between the new orders and the inventories in the ISM manufacturing index was this negative. The U.S. was already in recession. So you can see here, we've come down. This is going to be new orders versus inventories. So one of the best indicators of recession is a 6-month rate of change for the leading economic indicators. And here's the ISM. So again, everything is heading in the wrong direction. More indications that we have a recession on the horizon if we're not already in a recession. So here's annual performance and the backdrop against the ISM Purchasing Managers Index, PMI. And you can see here that when we're falling into the negative territory, returns aren't so stellar. So there is a correlation here. The point trying to make here is that this thing is now on the decline, as are the returns for the market. So if we are heading a recession, we may not have seen the end of the market turmoil just yet. I saw this. I thought this was interesting. So recent developments, right? So the 210, the 2 and the 3 month here went inverted. So did the 2 and 10. That went inverted. Second quarter GDP is expected to fall by 2.1%. That would put us in a technical recession, right? Because first quarter was negative. If second quarter turns out to be a negative number, then we may already be in a recession. Consumer confidence at all-time low. We all know about the inflation. But this one here was interesting. Credit card debt up 20%, and mortgage rates are hitting 6%. I think this is important because he goes on to say, since April, credit card debt has risen 20%. This is the largest 3-month increase in credit card debt since 2008. So he says people are literally trying to delay the effects of recession with credit card debt. Record credit card debt with rising rates probably doesn't end well. All right, I'm going to talk a little bit about the coming earnings season and why this is going to be important. If we are heading into a recession, we're going to see a pretty dramatic decline in corporate earnings, which would be bad for stocks, right? So according to FactSet here, As of today, we're expecting about 4.3% year-over-year growth for the second quarter for the S&P 500. So we haven't really been seeing the second quarter numbers come down. Again, FactSet, they came out and asked, are analysts lowering their estimates for the second quarter more than average? The answer is no. Over the past 3 months, analysts lowered EPS for the second quarter by a smaller margin than average. And according to this, they are still increasing the full year guidance, but I think this earnings season is going to be starting. I think it's going to be a tough earnings season. I think it's going to impact the market. We're going to see a lot of negative pre-announcements, I think. I thought this was kind of interesting. So you see here companies issuing guidance prior to releasing their second quarter numbers. Right, so they're saying, given the concerns in the market about possible recession, are more S&P 500 companies than normal issuing negative guidance? The answer is yes. They're saying more S&P 500 companies are issuing negative guidance for the second week and for the full year compared to recent averages. So we are seeing some companies warn, guide lower. So again, I think this earnings season is going to be very important, and it's going to be key as to where the market goes over the next several weeks and months. This here was a cool chart that I came across. So this is the deviation of earnings above or below the long-term trend. So you can see here's tech, here's real estate. This is the liquidity bubble that happened 11, 12. And here we are now. So we're at extreme levels. So again, these earnings forecasts that are out there probably need to come down to kind of adjust for a recessionary environment. I think also what's going to hurt corporate earnings is just the action by the Feds, right? So here's the Fed funds rate, and here are the forward growth rate for the S&P 500. Obviously, an inverse relationship. Once the Fed starts tightening, growth comes down. Tighten, growth comes down. Fed starts tightening, growth comes down. So here we are. I'm thinking growth is going to come down. That's probably going to affect the multiples of the market. While they may look cheap now, I think they're trading below their 10-year average. That's going to change if we see earnings start to drop off. All right, so this is the 12-month forward earnings as per FactSet. And you can see here's that COVID decline, pretty dramatic decline. But since then, we've recovered. And it's been going up in a pretty good line. You can see right around here, it started to level off. So the slope of the line is starting to come in. If this thing starts to roll over as we enter a recession, I would expect a little bit more weakness in the market. Although I do think you can see here, a lot of it is built in. All right, so lastly, with the earnings, I saw this interesting tweet from Lance Roberts. New home sales leads the S&P 500 forward earnings. Right, so what we're seeing here is new home sales have really fallen hard. So we would expect forward earnings to follow suit, which is going into that whole earnings recession theme that I think is going to start to happen. So a lot of folks are saying that without a decent rally in the tech sector, the market isn't going to get a sustainable rally, right? So this is interesting. The tech sector, which we need to kind of lead the way, I think, is the most exposed to foreign currency translation. So with the dollar given where it is and the strength, this could also impact negatively the forward-looking earnings for tech and other sectors exposed to foreign business as well. This corporate earnings season for the second quarter is going to be very important. I think it's going to be softer. I think there's going to be an indication that we're heading into a recession, and I think that could further depress stock prices somewhat. Again, a lot of it is built in, but we're just going to keep the portfolio neutral, try to capitalize in either direction, just try to capitalize on the volatility. All right, so what does all this mean? I think that the inflationary trade is dying. I think the recessionary risk trade is gaining momentum. And I think corporate earnings are going to suffer some consequences. So how do we trade this? Okay, so I'm looking at the S&P 500 monthly chart. And there are a couple of rules that I like to watch for. So number one, MACD histogram should turn negative. And we saw that here back in 2000 or late 1999, early 2000. We also saw it in the beginning of 2008. We saw it in 2015, but it never followed through on the other rules. And we also had some sporadic, COVID crisis, and this is when the Fed went overly aggressive in raising rates. But thinking in hindsight, they probably were right. Anyway, we did see the MACD histogram on a monthly basis go negative, and that was right around here. Okay, so new rule number 2, we have to breach the RSI 14. So this is the 14-month RSI, and when I say breach it below 50. This middle center line here. So you can see here in the previous recession we did breach it. We breached it here, and we also did breach it now. So rule 1 and 2 have been fulfilled. So number 3, I'm looking for the 20-month simple moving average to slope negative. Now that has occurred in the past, in 2000, in 2008, and we're not quite there yet, but you can see down here we are maybe a month or 2 away from seeing the 20-month start sloping negative. So I think rule 3 will take place. And then what's going to happen here in rule 4 is that we're going to try to retest both the 20-month SMA, simple moving average, and the RSI 14 to the 50 level. So I'm expecting this thing to come up here and try to retest. Now the 20-month SMA is about 42.23, 42.25 I think is a key level, and also we're below the 50 line, so it may come up here and try to retest the 50 line on the RSI. And if it fails and starts heading lower, then yeah, it's time to get out of the market, because not only can we retest the lows, but you can see here in many cases we actually fell beyond the lows. So a very, very tricky part in the market right now. On a monthly basis, 2 of the 4 rules have been met. If 3 and 4 are met, then we have to follow rule 5 and either hedge our downside in a big way, or like I trade, I stay neutral. I might, if this were to happen, I might take an overly aggressive downside bias in the portfolio. But anyway, that's where we are with the S&P on the monthly basis. So S&P weekly basis, you can see here that from the lows that we hit in 2020 up to the peak, here we got the Fibonacci's. So the market sold off, and we've actually been hovering around here to 38.2% Fibonacci level. We broke through it a little bit, but we really couldn't break the 50% level, which also coincides with the 200-week moving average. So if anything, if we are going to come and retest lows, I would say that this level here on the S&P 500, is call it like 3,500 or so, would be a major area of support and a key level to watch. But if we do rally back, I could definitely see this market coming up to this area right here. So if we really rally back to 4150, which is the moving average, and 4225, which is that monthly number that we were looking at right here, the 20-month moving average, then I think this could act as a major area of resistance to head lower. So on a daily basis, we're seeing we're coming off. We hit a higher low, which is a good sign, right? And we are kind of rallying back. We're coming back. I think this 20-day moving average needs to at least level off and at best start curling higher, sloping higher, because this thing just in a downtrend like this is ugly. So if we can stay above this area or rise and see this thing kind of hold on, maybe level out and start sloping upward and act as support, that would be a really good sign. Doesn't really seem like it right now, but yeah, so I shaded this in red. So this kind of corresponds with that monthly number that we were talking about, the weekly number that we were talking about. So if you just look at it intuitively, here was the low. We broke through. It acted as, so here was support. It broke support, acted as resistance. So, you know, this red area, if we do get a rip your face off rally, a bear market rally, I could see it going as high as, you know, this 4150, 4200 area. But it's going to hit a lot of resistance right here. This is a key level to break through. And also, by the way, this 4220 also represents a 50% retracement off the June lows. So I did the Fibonacci from the high to the low. We hit a lower low, so I'm going to count this as the low. So yeah, this is a key level. All right, so I'm going to wrap this up and get out of here. So we're exiting the risk-off concerns about inflation, and I think we're now focusing on the concerns that we have about an economic slowdown and economic recession. I do think we're heading to an economic recession. I do think that we're going to start to see that in earnings numbers coming down, and I think this is going to be a key earnings season. That said, I do think that the market could have a rally through July, and it could be a monster rally up into some of these levels here that we discussed. But then it's going to take a turn for the worse, and I say that for a number of reasons. Here's where we are versus past bear markets since 1929. So you can see that, yeah, this red line is where we are now, and we've come off pretty hard. But during recessionary periods, the market has bounced back, but then has come back down to at least retest the lows. So I don't think the selling pressure is over. I also view the election cycle, right? So here's how the market reacts during a typical 4-year election cycle. So here's your election year and what the market would do. Your post-election year. This is your midterm elections, and this is your pre-election year. And you can see that your midterm election year, which is where we are now, is usually the worst performing year. So history in terms of just the economic and political cycle is just not going for us. So this is the political cycle during midterm elections. And you can see that the month of July during midterm election year, the market does well. And I'm anticipating that the market can have a strong rally in the month of July up into our points of resistance. But then you can see August and September really, really monster sell-offs. So, in fact, September is a really bad month in midterm elections. And then you see the market kind of like rebound here in October, November, December. So what does all this mean? It means that I'm going to continue to keep the portfolio as balanced as possible. Right now, if you take a look, I'm almost 50-50 positive, negative bias, although because of timing issues, the delta on my positive side is really starting to deteriorate. So I'm a little bit, I'm not as exposed to the upside as I want to be. So I need to work on that and get some additional positions in there. But for the most part, I think July is going to be okay. I think this rally could continue. Points of resistance here, as I said, this is the 50 week. This is the 50-day. We break through that, and then we're up here in the 4150, 4200, which is going to be a really, really tough range. If we do make it to this level, I think it curls over. I think it could be a very ugly September, could be an ugly October. That's okay. I'm going to stay neutral. I'm going to try to capture some of that downside as well. And then as we get to the end of the year, we'll probably see a year-end rally. So just my thoughts on the market. I could be wrong. I could be right, but at least I have a plan, right? So until next time, take care.